Oh boy, there are going to be some juicy opportunities coming up in real estate. In this video, as I head to the airport to go check out more real estate, we want to break down where those opportunities might be. First and foremost, a lot of folks are looking at price action and are wondering, hey, if December was the bottom, where is there an opportunity today, especially when inventory is still as low as it is? In fact, month supply is maybe at similar levels to the last 2 years, but actual standing inventory is somewhere around 20 to 30% less than where we were in the last 2 years, which the reason for that is less people are buying. How could there potentially be an opportunity? And there are a few different opportunities. There's the commercial side where you've got potentially opportunities in medical building conversions. That's a big deal right now. Probably a much bigger opportunity than you've got in just getting into the good old usual pandemic Airbnb play. The other opportunity, in my opinion, is actually renos, your classic not fix and flip style properties. Now, the reason I said not fix and flip is because in a high interest rate environment, you take on a lot of risk flipping real estate. In fact, I generally never encourage flipping because you're too subject to market risk. But there's something very unique about the profile of people who are actually buying homes today. Most of the people, we're on autopilot by the way, full self-driving here supposedly, but we've got a beautiful iPhone mount as well so we can pay good attention. Most of the people buying today seem to be folks who not only have the ability to repay, given that our non-QM, our non-qualified mortgage levels are less than 5%, which basically means 95% of people have not only the ability to repay, which I guess to some regard you need to have the ability to repay for a non-QM loan as well, but the point is 95+% of loans are actually your conventional, normal debt-to-income ratios, which means people can actually afford the homes they're buying right now, which is mind-blowing because homes seem very unaffordable, right? But because people are so stretched in terms of, okay, we can afford it, but now that's it, like we can't afford any more in that regard. We don't have a bunch of extra cash to do renovations. What kind of properties are creating the best opportunities to buy? Well, it's fixers. The Wall Street Journal just did a fantastic profile on home buyers that we're actually seeing buying homes today. And most of them are people who are either tech couples or in some sort of software business. They're entrepreneurs or they're employees of software companies. They're making great W-2 incomes. And what they're doing is they're betting. They're making a bet. They're saying, look, we think rates are going to go down. Let's buy the home we want now, and then we'll hodl it. That limits a real price discovery because people are already betting that rates are going to come down, which obviously the longer rates stay higher, the worse it is for real estate. But not only are people making that bet, which minimizes some of that potential pain that you would otherwise experience in real estate, fewer people are selling. But here's what's happening. The people who are buying are wanting to buy based on that Wall Street Journal profile and what we're seeing in the markets and what we're talking to realtors about, so getting anecdotal evidence on, is people are wanting to buy move-in ready properties. That's because the type of person who's buying these properties and can qualify at these prices is not interested in doing renovation work to try to make an extra buck. They'd rather work more at the job they're doing than try to make a buck doing paint, carpet, and electrical stuff and dealing with contractors and all the headaches that they don't want to deal with. So what this actually does is you're in this weird real estate environment where many markets had a big correction last year. Some were up to 20%, Boise, Austin, Phoenix, Florida, not so much. And you're still seeing some residual of that. Some of these markets still down 10% from their peak in May of 2022. That's already giving them some credit for appreciation this year. Anyway, what you're finding is that even in these markets, you're putting a floor under real estate prices because of the lack of willingness to sell homes. And on the flip side, because of buyers' willingness to bet that the real estate pain will be transitory. So this then sets us up for two potential avenues to take for actually buying real estate. Avenue number one is you just sit around and wait forever. The risk of waiting forever is as rates normalize and as even inventory normalizes, you end up with a balanced market that either stays flat or slowly trends up again. That is a risk, right? Your upside risk. Of course, the hope is that you're going to have some kind of big 20-30% real estate correction. And while we already had that in certain markets like Boise, Austin, and Phoenix, that's probably behind us. So the other potential avenue is, all right, well, look, if you're not going to have a big crash again, beyond the pricing correction that you've already had, where is the leftover opportunity? Well, I mentioned one is medical opportunity, potentially converting office space or commercial space to medical. But the second opportunity is buying fixer-uppers, because you have less people flipping homes right now. You have a lower appetite for people to actually get into real estate. Why would you have a lower appetite for people to get into real estate? Well, because A, people don't want to do renovations. B, rates are high. And when you have a less interest in doing renovations and rates are high and affordability is really, really stretched, the only people buying are the people who are like, I don't want to do any work. Then what you do is you kind of sliver out a section of the market where people are playing ball. And I don't expect people will play a lot of ball this winter. And that's why I think come this October, probably all the way out to about February, we're going to be in a unique buying window where we're going to have a confluence of factors, fancy word. We're going to have this collection of factors that say, okay, this could be really good. Now let me break down what those are. Inflation think about it, by November, we should be pretty comfortable that we're at peak interest rates. Inflation is over and we're trending down. We should be very comfortable with that. In fact, we should also have some gauge as to how bad is the unemployment issue going to get. The Fed thinks we're going to get to 4.5%. Does that mean we're going to end up getting to 5.5% and they'll end up having overcorrected? We should have a lot of that intel by October, November, December. Well, in October, November, December, the people who generally sell are not discretionary sellers. They're people who have to sell. Trust sales, hoarder homes, basically properties that need to sell, fixer-uppers. But you're still going to have high rates, which means low to no investor competition. Investors already falling off a cliff. Nobody wants to flip, right? This is a great opportunity potentially. And you should be on a trajectory to rate declines, which should be supportive to not only you buying a good deal this winter, but then potentially having tailwinds after the fact. Again, predicated on unemployment not going to the moon. So obviously, if unemployment skyrockets and we have a really big recession, well, then we've got bigger problems, right? And we have actual problems that we really have to get to the bottom of, and that could take years. Personally, I don't believe that a recession is imminent. I think that a recession is likely, but I think that the inverted yield curve could be telling us that a recession is still 2 years away. I know that's crazy to think about, but it could be 2, 3, 4, 5 years away. We don't know. There's this massive lag and unknown consistency of that inverted yield curve. And one of the reasons why the inverted yield curve always seems to be right is because people stretch out how soon that recession needs to happen. Sometimes you get an inverted yield curve, you get a recession within 12 months. Sometimes you get an inverted yield curve and you don't get a recession for like 56 months, which if you think about it, that's like 4.7 years. That would be like a recession in 2027 or 8. That could happen. So when we put together the data, not necessarily that we have now, we don't want to play crystal ball, but when we get to October, I think we're going to be looking at a market where we're like, okay, the people who are buying, who are supporting home values don't want to do renovations. That's an opportunity in the single family and multifamily space. Investors aren't flipping right now because it's a risky time to flip. You'll still have high rates. So a lot of people are going to be like, I'm better off with my treasury yields than buying real estate, which I think is probably not the best idea, mostly because with real estate, you have the benefits of depreciation for your tax benefits. Look at the Medical Properties Trust. I mean, they take like a $300 million loss I think this morning we analyzed it in the course of my live stream. It's like a $340 million loss for depreciation. Depreciation, when you add that back in, that's what they're basically paying out in dividends. I mean, it's remarkable. Anyway, ignoring the medical properties trust for a moment, I do think there's some opportunities there. Ignoring that for a moment, look, it's the Tesla lot. This, by the way, right here is the lot. There's nothing in front of me, dude. Everything's fine. This, by the way, here, I don't know if you can see it, there's a lot right here, and they drop off the Teslas here. And sometimes this lot is full, and then they grab them like 2 or 3 at a time, drive them across the street to the delivery center. Anyway, I love seeing it because it keeps gets filled up and then it's sold. Fills up, sold. It's kind of cool. But anyway, you have this potential joining of factors here that says, man, you know, depreciation, leverage depreciation, probably already experienced flattened rents, so then you'll get back to rental appreciation. When you add all of these factors together, real estate is potentially setting up for glorious opportunity. I don't think it's going to be a 2008 style opportunity at all, and that's okay, because think about it. In 2008, you don't have liquidity. So in 2008, you might be like, yeah, I want to buy homes in 2008, but look, I became a broker in 2008. Well, in that 2008 recession era, it was after 2008, I became an agent and a broker. But anyway, what I realized was people didn't have money. So when people didn't have money, what are you stuck with? Well, you're looking going, man, these real estate prices are so low, but you can't buy anyway. You can't buy because nobody's got the money to buy. Now we're actually in this really neat place where A, there is money to buy, and B, you potentially combine that also with an opportunity to buy, which I'm really excited about. So, for me, I'm jumping up and down thinking this winter season could be a big opportunity. We'll obviously see how things evolve here, but I gotta go catch a plane now, which is pretty exciting. So let me know what you think in the comments down below. See a lot of negativity out there on the real estate market, and I'm personally not seeing it, at least not that bad. I see it as an opportunity rather than super bad. So we'll see. But again, I want to hear what your comments are. Let me know what you think. Get my little iPad mini over here and go read while I'm on the plane and study some more. See you soon. Bye.